Some welcome news for the U.S. economy. New numbers show a sharp turnaround after a worrisome first quarter. CNN senior reporter Matt Egan is joining us here in the Situation Room. How big of an improvement is this new report for the U.S. economy?
Well, Wolf, the headline here is a positive one, right? GDP, the broadest measure of the U.S. economy, it did rebound in the second quarter, 3%. That is a solid number. And it also beat expectations. This marks a major improvement from the first quarter when we saw a rare contraction. So that's the good news. The bad news is economists say that this headline GDP figure, it's misleading. And that's because the trade war is distorting all of these metrics. In the first quarter, we saw imports crash because of high tariffs, right? Businesses, consumers, they're trying to beat the clock on tariffs. We saw a reversal in the second quarter where imports this time, they actually went down sharply because of tariffs. And when that happens, that subtracts from GDP, that actually adds to GDP. And so that's why economists say that this GDP improvement, it's really a mirage and that this economy actually lost steam. Fed officials and economists, they like to look at core GDP. It was just 1.9% in the first quarter. In the second quarter, Wolf, it slowed to 1.2%. That paints the picture of an economy that is slowing down.
On a related matter, we're just a few hours away now from a Federal Reserve decision on a possible interest rate cut, which is what Trump keeps calling for. The Federal Reserve Chairman, Jerome Powell, so far has refused to cut those interest rates. What are we anticipating?
Well, Wolf, Fed decision, always a big deal. A lot more drama this time because, as you mentioned, the president has been pounding the table for interest rate cuts all year, and he's not looking for slightly lower interest rates. He wants dramatically lower interest rates. And look, that's just not going to happen. The market is pricing in almost no chance of even a tiny cut at today's meeting. There is about a 62% chance of an interest rate cut at the next meeting, the one in September. But this decision today, it could shine a light on some growing pressure from inside the Fed. For the first time since 1993, Fed watchers expect that 2 members from the Fed's powerful board of governors will dissent, and that does speak to some pressure on the Fed, not just from the president, but also from Powell's own colleagues.
And we'll know the result of the decision today when?
2 p.m. Eastern.
We'll be watching. All right, thanks very much, Matt Egan, reporting for us.
We are watching to see how Wall Street reacts, with central bankers widely expected to keep interest rates unchanged for the 5th consecutive time. In the last hour, the president took to social media to re-up his pressure campaign on the Fed. Mr. Trump calling yet again for a rate cut after the U.S. GDP growth in the second quarter beat expectations. Well, with us to discuss is Diane Swank. She's chief economist at KPMG. Good to have you. According to the CME Watch tool, there's only about a 3% chance central bankers will cut rates today. What's your view at this point?
Well, I don't think they're going to cut today. We could see a dissent. Governor Waller and Governor Bowman have both signaled that they could dissent, worrying that the effects of tariffs on inflation are likely to be transitory and have a greater effect on underlying growth in the U.S. economy. Now, we've seen tariffs whipsaw growth this year. We saw negative 0.5% in the first quarter, a rebound to 3% in the second quarter. You average it out, and underlying growth has actually slowed this year from the second half of last year. But more importantly, in that GDP report is the implicit numbers for what the Fed targets, their PCE inflation index. That number looks like it accelerated much more than expected, and in fact, in both goods and services.
All right.
That's bad news for the Fed, suggesting that tariffs are actually making their way through the economy.
And it's interesting, and I'm going to just push you on this, because the same prediction tool that I quoted earlier on does say that there is a much greater chance of an interest rate cut in September. If what you've alluded to there, which is the inflationary pressures potentially or most likely from these trade and tariff issues, why would you expect, if you concur with this tool, a cut in September?
Well, I don't expect a cut in September, but the Fed has made it clear that there's a group in the middle that are not sure which effects will dominate. And if we start to see some weakness in employment, and even though that didn't show up as much in today's ADP report, what really matters is what are the next two employment reports going to look like, and how much will that destruction of demand eventually bring down tariffs? And so that's where the next shoe is waiting to drop, is how much weakness will we actually see in the labor market.
And Diane, for the past 32 years, the Federal Reserve's decisions on rates have almost always been unanimous, with the occasional dissent from a lone policymaker. But as you rightly point out, it's sort of widely understood that that may not be the case today. It could actually draw dissents from two members of the central bank's board of governors. If that were to happen, it would be the first time in 32 years. What does it tell you about the division within the Fed at this point?
Well, I think it's really more subtle than it looks like on paper, and that is that Chris Waller has made his case clear. Whether you agree with him or not, he has consistently argued, he has a lot of intellectual heft within the Board of Governors. He believes the economy is going into weakness. I have empathy for his weakness in the labor market. I just think that the inflation will be more persistent than he does. These are shades of gray, but it's a place he's willing to stake it out, because history on tariffs is that they're a one and done phenomena. The problem is the way these tariffs have been rolled out is not a one and done phenomena.
We've heard insults from Donald Trump about the Fed chair, describing him as a major loser, as a numbskull. He's walked back a little bit of this recently, saying that he knows Powell will, quote, do the right thing. But by doing the right thing, Mr. Trump wants to see a significant reduction in rates. He wants to see as much as 3% off interest rates. He says for every 1%, it is costing the Treasury effectively $300 billion. Firstly, is he right? And secondly, what do you make of this pressure from the US president on an entity which is supposed to be independent?
Well, I certainly haven't seen anyone out there argue that interest rates should currently be at 1%. And if they were, that would suggest the economy is significantly weaker, with potentially the threat of a financial crisis, which could be the case, but that's not where we're at today. And so the intellectual consistency in that argument is you have to argue that we are so weak that we need to have ultra low rates, below anything that would be considered neutral, in order to stem off a recession or worse. And that's certainly not what the administration is currently arguing. So I think that's important. In terms of the independence for the Fed, Jay Powell has been clear. He believes in an independent Fed, and he's pretty much unflappable when it comes to this issue.
It's good to have you, Diane. Thank you very much indeed. I know you'll be keenly awaiting that announcement by the Fed, as are the markets today.